Hi guys, welcome to our channel, The Mechanics of Making Money. Today, we're going to explore a fascinating and popular investment vehicle that's been making waves on Wall Street, SPACs, or Special Purpose Acquisition Companies. These intriguing financial instruments have been capturing headlines and attracting investors from all walks of life. But what exactly are SPACs? How do they work? And why are they such a compelling source of income? Well, we're about to answer all these questions and more. We'll demystify the world of SPACs, breaking it down to its core elements, and help you understand how it could potentially fit into your investment strategy. Whether you're a seasoned investor or just starting out, there's something for everyone as we unravel the complexities of these financial tools. So brace yourself as we dive into the world of SPACs. First things first, what exactly is a SPAC? Well, let's dive into it. SPAC stands for Special Purpose Acquisition Company. It's a type of investment tool that's been gaining quite a bit of traction in recent years. Think of a SPAC as a sort of shell company. It's an entity that's formed strictly for the purpose of raising capital through an initial public offering, or IPO. This capital is then used to acquire an existing privately held company. So why the name Blank Check Company? Because investors give their money to the SPAC without knowing which company it will eventually acquire. It's like writing a blank check to someone and trusting them to spend it wisely. The formation of a SPAC is typically spearheaded by a sponsor or group of sponsors. These sponsors are often seasoned business executives or institutional investors with a track record of success. They form the SPAC, take it public, and then search for an attractive private company to merge with. Once the SPAC goes public, the raised funds are placed in an interest-bearing trust account. These funds can't be disbursed except to complete an acquisition or to return the money to investors if the SPAC is unable to find a suitable acquisition within a specified time frame, typically 2 years. The primary purpose of a SPAC is to provide a more efficient path for a private company to go public, bypassing some of the traditional hurdles and red tape associated with the IPO process. It's important to note, however, that while SPACs can offer significant opportunities for growth, they also come with their own set of risks. Just like any other investment, it's essential to do your homework and understand what you're getting into before you jump in. So, in a nutshell, a SPAC is a blank check company that raises funds to acquire a private company, providing a novel avenue for such companies to go public. Now that we know what SPACs are, we can look at how they work. So, how do SPACs work? Well, the journey of a special purpose acquisition company, or SPAC, begins with an initial public offering, or IPO. A group of sponsors, often experienced business moguls or investment firms, create a SPAC with a specific purpose in mind: to raise capital through an IPO and use this capital to acquire a private company. The SPAC is often referred to as a blank check company because it has no commercial operations of its own. It's simply a vehicle for taking a private company public. During the IPO, the SPAC sells its shares, typically at $10 each, and the money raised is placed in a trust account. Once the SPAC has successfully raised capital, the clock starts ticking. Typically, the SPAC has about 2 years to identify a suitable private company to acquire, or in other words, to merge with. This is a critical phase, as the success of the SPAC largely depends on the quality of the company it acquires. The sponsors are the ones who lead the search for a target company. They're looking for a diamond in the rough, a company that has great potential but is currently undervalued. When they find a promising company, they negotiate a deal. Now here's where it gets interesting. The shareholders of the SPAC, the people who initially bought the shares during the IPO, get to vote on whether they approve of the proposed merger. If the majority approve, the merger goes ahead. If not, the SPAC is liquidated and the money from the trust account is returned to the shareholders. Assuming the merger is approved, the private company becomes a public company, and the SPAC shareholders become shareholders in this new entity. The SPAC, having fulfilled its purpose, ceases to exist. It's quite a process. Why are SPACs so popular and how do they generate income, you might ask? Let's look at that. The popularity of SPACs is largely due to their ability to provide quick access to public markets for private companies. This bypasses the traditionally lengthy and complex initial public offering, or IPO, process. For investors, the allure lies in the potential for high returns. But how do SPACs generate income? It's all in the acquisition and merger process. When a SPAC merges with a private company, The private company essentially becomes a publicly traded company overnight. This process can lead to a significant increase in the company's market value. Investors who bought shares in the SPAC can then sell their shares at this higher market value, potentially making a tidy profit. It's a bit like finding a diamond in the rough, polishing it up, and then selling it on for a higher price. But like all investments, SPACs come with their own set of risks. What are the risks associated with investing in SPACs? Now, that's a question worth pondering. Like all investment vehicles, SPACs come with their share of risks. One of the most significant is the uncertainty surrounding the acquisition target. When you invest in a SPAC, you're essentially putting your trust in the management team's ability to find a profitable merger. However, you're in the dark about who that merger might be with, and that can be a gamble. Moreover, there's also the potential for a loss of investment. The SPAC has a set time frame, typically 2 years, to complete a merger. If this deadline isn't met, the SPAC is liquidated, and the investors get their money back. But here's the kicker. While you do get your initial investment back, you lose out on the time value of that money. So there you have it, a comprehensive look at SPACs, their workings, their benefits, and their risks. In conclusion, SPACs, while popular, are not a guaranteed moneymaker. Remember, they provide a unique investment opportunity, offering Wall Street-like income potential. It's vital to understand how these entities operate, their benefits, and the potential drawbacks before investing your hard-earned money. Be informed, be diligent, and never stop learning. Thanks for watching. Please remember to like, subscribe, and share so you see our future videos pop up on your newsfeed. Stay safe out there, guys.